Today, we're tackling a topic that is absolutely fundamental to success in the markets, yet so many people overlook it. We're talking about building a rock-solid trading plan. Think of it this way. Would you build a house without a blueprint? Would you go on a cross-country road trip without a map? Of course not. So why would you risk your hard-earned money in the markets without a plan? A trading plan is your business plan for trading. It's your personal rule book that guides every single decision you make, keeping you disciplined and preventing emotional mistakes. It's what separates the consistently profitable traders from those who just gamble and hope for the best. So, if you're serious about taking your trading to the next level, stick around, because we're about to lay out exactly how to build a plan that works for you. First things first, what exactly goes into a trading plan? At its core, it's a detailed document that defines your trading goals, risk tolerance, and the specific rules you'll follow for every trade. It's not a one-size-fits-all document. It has to be tailored to your personality, your lifestyle, and your financial situation. Let's break down the essential components. The very first thing you need to define is your motivation. Why are you trading? Are you looking for a side income, long-term wealth growth, or maybe even to make it a full-time career? Your why will keep you grounded during the tough times. Next, assess your commitment. How much time can you realistically dedicate to trading each day or week? Be honest with yourself. Trying to day trade when you only have an hour in the evening is a recipe for disaster. Your time commitment will help determine what style of trading is best for you. Whether it's scalping, day trading, swing trading, or position trading, once you have your motivation and time commitment figured out, it's time to set clear and realistic goals. Don't just say, "I want to make a lot of money." That's not a goal. It's a wish. A good goal is specific, measurable, achievable, relevant, and time-bound. For example, a goal could be, I aim for an average monthly return of 5% on my trading capital while risking no more than 1% per trade. And I will review my progress quarterly. This kind of goal gives you a clear benchmark to measure your performance against. It keeps you focused and allows you to see if your strategy is actually working. Without measurable goals, you're just flying blind. You have no way of knowing if you're improving or just getting lucky. Now, let's get into the nitty-gritty of your trading rules. This is the heart of your plan. The first rule you must set is your risk management strategy. This is non-negotiable. You need to decide the maximum percentage of your trading capital you are willing to risk on a single trade. Most professional traders recommend risking no more than 1% to 2% of their account on any given trade. This ensures that a few losing trades won't wipe you out. You also need to define your risk-to-reward ratio. For instance, you might decide to only take trades where the potential profit is at least twice the potential loss. A 1-to-2 risk-to-reward ratio means you can be wrong more often than you rewrite and still be profitable. Your plan should also detail exactly where you will place your stop-loss orders to automatically exit a trade if it goes against you, and where you'll take profits. These decisions should be made before you ever enter a trade, when your mind is clear and objective. With your risk rules in place, the next step is defining your exact entry and exit criteria. This is your trading strategy. What specific conditions need to be met for you to enter a trade? Are you using technical indicators like moving averages, RSI, or MACD? Are you looking for specific chart patterns like head and shoulders or triangles? Or maybe your strategy is based on fundamental analysis of a company's earnings. Whatever it is, it needs to be written down in black and white. For example, I will enter a long trade only when the 50-day moving average crosses above the 200-day moving average on the daily chart, and the RSI is below 70. Your exit rules are just as important. When will you exit a winning trade? Will you use a trailing stop loss to lock in profits? Or will you exit when the price hits a predetermined target? What about exiting a losing trade? Your stop loss handles that, but you need to commit to honoring it. No exceptions. So, let's put this all together into a pre-trade checklist. Before you even think about clicking that buy or sell button, you should run through a mental or physical checklist derived from your trading plan. Ask yourself these questions. Does this potential trade align with my overall market analysis? Does it meet every single one of my entry criteria? Have I determined my exact entry price, stop loss level, and profit target? Is the risk-to-reward ratio acceptable according to my plan? Am I risking only the percentage of my capital that my plan allows? Am I emotionally neutral and not forcing a trade out of boredom or greed? If you can't answer yes to all of these questions, then you simply don't take the trade. It's that simple. This checklist acts as your final gatekeeper, preventing impulsive decisions and ensuring you stick to your well-thought-out strategy. It's your last line of defense against your own worst enemy, emotional trading. Now, creating the plan is one thing, but sticking to it is where the real work begins. This is where a trading journal becomes your most valuable tool. A trading journal is much more than just a record of your wins and losses. For every single trade, you should document everything. Write down the date, the instrument you traded, the entry and exit prices, your initial stop loss, and the final profit or loss. But don't stop there. This is the crucial part. You need to record asterisk, why asterisk you took the trade. What was your rationale based on your trading plan? What were the market conditions? How were you feeling emotionally at the time? Were you confident, anxious, or impatient? You should also take a screenshot of the chart at the time of entry and exit. This creates a powerful visual log. By diligently keeping this journal, you create a feedback loop for improvement. You're not just trading. You're studying your own behavior and decision-making process under pressure. Reviewing your journal regularly, say, every weekend, is where the magic happens. Look for patterns. Are you consistently making the same mistakes? Maybe you're moving your stop loss too early or holding on to losers for too long. Are your best trades coming from a specific setup? Maybe you should focus more on that. The journal will reveal your strengths and weaknesses in a way that nothing else can. It provides objective data about your performance. It tells you the truth, even when you don't want to hear it. Are you actually following your plan? The journal will show you. If your results aren't what you hoped for, your journal is the first place you should look to diagnose the problem. It's the key to turning your experiences, both good and bad, into valuable lessons that make you a better trader over time. Finally, remember that the market is not a static entity. It's a dynamic, constantly evolving environment. What worked brilliantly last year might not work so well this year. That's why your trading plan shouldn't be set in stone. It needs to be a living document that you adapt and refine over time. This is where your journal comes in again. If you notice from your journal that your strategy's performance is starting to decline, it might be a sign that market conditions have changed. Perhaps volatility has increased, or the market has shifted from a trending environment to a range-bound one. This doesn't mean you should abandon your plan at the first sign of trouble, but it does mean you need to be aware and willing to make calculated adjustments. You might need to tweak your entry criteria, adjust your profit targets, or change the indicators you use. Any changes should be based on data and thorough backtesting, not on a whim. The goal is to adapt intelligently, maintaining your core principles of risk management while refining your strategy to stay in sync with the market. Your ability to adapt, guided by your plan and journal, is what will ensure your longevity and success in this challenging but rewarding field. So there you have it, a comprehensive guide to building and maintaining a trading plan. It's your blueprint for success, your guide for discipline, and your tool for continuous improvement. Take the time to build one. Write it down, keep your journal, and review your performance honestly. It's the most important investment you'll ever make in your trading career. Thanks so much for watching. If you found this helpful, give this video a thumbs up and consider subscribing for more content to help you on your trading journey. Until next time, trade safe and trade smart.